So this is a depressing presentation. I'll just start out by saying that David, was saying, I liked your paper. It was really scary. So let's talk about my scary paper. Done in conjunction with David Blanchett from Morningstar and Wade Pfau, also at the American College. I'm going to start out by talking about the life cycle hypothesis. We all know the life cycle hypothesis, but let's look at this graph just one more time so we begin to understand what we're doing in this paper. We're trying to figure out, for the average worker, of course, they're going to be saving during their working years, they're going to be dissaving after retirement, but what do these lines have to look like? What does this saving line need to look like? What does this consumption line need to look like? And one of the main points of the paper that I'm going to give away right now is that not enough thought is given really to consumption. We very often reflexively say that everybody needs to be saving more. Well, of course they need to be saving more if they're going to be smoothing their spending in a low-rate environment, but the implication of that is that we're going to be living worse. So that's the bottom line. So let's look at what's going on, and I feel like I've just skipped over a bunch of slides. I have. Changes in longevity. We're gaining about a year every decade after the age of 65 in the United States. And also, joint longevity is changing. During the Mad Men era, men were smoking at a much higher rate than women, and we saw that difference in longevity widen to about 4 years. That's narrowed back down to 2 years, which is really the historical average for difference in longevity between men and women. That has implications when it comes to joint longevity, because what we're going to see, especially among more educated baby boomers who tended to marry spouses that were about the same age, we're going to see them living a long time, or at least one of them living a long time. Where our best guess is that for those higher income couples, there's about a 43% chance that one of them is going to make it to the age of 95. Let's look at this, because this is also very fascinating. This is a relatively recent phenomenon that's been going on in the United States, and that is that there is this linear relation between improvements in longevity and Social Security earnings over a lifetime. It's a monotonic effect, and it's actually more dramatic for higher income males than higher income females. Again, post-Mad Men era, men are not smoking as much as they have in the past. They're getting up in the morning and having a kale smoothie and going for a jog. They're doing things differently than men did in higher income groups in previous eras, and what that means is that they're going to have more expensive retirements. Well, let's take a step back. They're going to have more expensive retirements. Millennials are going to have more expensive retirement. If you compare millennials, they're going to have to fund 4 more years on average versus baby boomers after the age of 65 in a lower return environment. So the news is it's not bad news that they're living longer, but the news is they're going to have to save more. All right, so asset returns. And I'm going to show some of the same slides that other people have shown because they're so much fun because they're so depressing. This is the historical returns on equities and bonds. And the point I want to make here is that we've gotten very accustomed to equities bailing us out of bad habits historically. So that relative performance of equities versus bond, the historical equity premium that's been experienced, and someone made the point that their expectations of the equity premium in the future are something like 5 to 6% nominal, so that was more like 3% real return on equities in the future. That's going to be a big change in terms of the amount of return that we're going to be able to get from a balanced portfolio. So let's look at the change in asset prices, and we may begin to think that initially that this is a relatively recent phenomenon, that this is something that's happened since the year 2000. But no, actually, we can go back 20 years, and assets are significantly more expensive between the years of 1995 to 2015 compared to 1975 to 1994, 1955 to 1974. It costs roughly double the amount to buy $1,000 of bond income, to get $1,000 worth of dividends. And for those who are going to criticize the price of income because so many stock companies are repurchasing, even if you look at earnings, it's about double of what it's been over the past 2 historical 20-year periods. So assets are more expensive than they have been historically. The good old Schiller PE, which a lot of people like to criticize. And again, everybody knows the Schiller PE, but I just want to be able to take a step back and be very realistic about where we are right now when it comes to the Schiller PE and what that means about expectations of equity returns in the future. If you buy $100 worth of the stock market, historically you get $3.38 in dividends. You get $2.87 of that reinvested. Today, we get $1.95 in dividends, and $1.51 of that $100 is actually reinvested for growth. So can we, I mean, first of all, we're getting less income from equities, less money is being reinvested into equities. We cannot have the same expectations of equity returns as we have in the past. This was a paper from AEQ, Cliff Asness at AQR Capital, that showed that when stocks are as expensive as they are right now, historically over the subsequent 10-year time period, they've returned on average 90 basis points a year after the rate of inflation. But actually, when Cliff first wrote this paper, it was on a different road than where we are right now. We have to go down one row right now, and what we see is that historically when stocks have been this expensive, the subsequent 10-year return has been 50 basis points above the rate of inflation. So can we rely on equities to bail us out of this low yield environment in bonds? Probably not. And as we know, this is the same slide that you've seen over again. One of the points I want to make is that well, I don't even want to get into this argument, but this is obviously not. This is a demand issue when it comes to financial assets. We can all talk. We've even looked at the changes in supply of financial assets over the last 20 years. This is a big increase in bond supply, especially over the last 10 years. What's happening is demand is shifting outward. That means the prices are going up. That means expected returns are going down. Let's look at, well, I'm going to show you this slide because I want to present this. This goes all the way back to 1980. This is the price of buying $1 of an after-inflation dollar of income after the age of 65 in an actuarially fair annuity. So in other words, a real dollar of spending has doubled. The cost of a real dollar of spending has doubled in retirement between 1982 and 2015. This is something that maybe some pensions should pay attention to. It is now twice as expensive to buy one real dollar of income, actuarially fair income, and this includes improvements in longevity and reductions in yield and real yield on bonds. Okay, so I told you it was going to be depressing. Let's just do some simple, this is a very, and for those of you who are going to criticize this very simplistic way of thinking about it, we have a much more complicated analysis later on, but this is just to get us started thinking about what some of these implications of living in a lower yield environment are. And that 6% real historical return that we may have been able to achieve from an aggressive portfolio historically, at that rate of return for a worker that was making $50,000 a year with 1% real wage growth, they wouldn't have to save all that much to be able to smooth their income over a lifetime. But if you get down to 0% or 2% real, and how realistic is 0 or 2% real these days? Well, we know that bonds are returning about 0% real. We know that there's also asset fees that are applied to our investments. We know that equities historically have not been able to achieve much beyond 1 or 2% when they're as expensive as they are right now beyond the rate of inflation. So 2% is not an incredibly depressing, unrealistic expectation for a portfolio return, a real portfolio return after inflation in the future. And what we see is that it's about a third more expensive to buy you're going to have to, your lifestyle is going to be 1/3 worse over the course of your lifetime if interest rates are 2% real versus 6% real. So that's the depressing part. So, I feel like we may not fully understand the impact that low rates will have on consumption in a life cycle model, and the impact that they're going to have is it's going to mean that we're going to have to spend a lot less. So income replacement rates, and this is something for anybody who's in the retirement area and thinking about what replacement rates should look like at retirement of gross income, it's okay to have a 60 or 70% replacement rate, income replacement rate at retirement in a world in which real portfolio returns are 4 or 6%. But when real portfolio returns are 0 or 2%, and especially if there's any sort of a legacy goal, then your optimal replacement ratio is more like 50% of your gross income. And the reason it's more like 50% is because you're going to have to save a lot more money to be able to smooth spending in retirement. You're going to be accustomed to a much lower lifestyle during your working years, so you have to replace less of your income at retirement. Okay, so and you have to save more money in a low-rate environment. Not only are you living worse every year, but you have to save more money to fund the same income in retirement. So none of the news is good. Okay, so the good news is that it's really not as bad as that life cycle model would lead you to believe, because there are other factors that are going on here, like progressive tax rates, like Social Security. Another factor that is oftentimes not discussed is that we are not really smoothing spending in retirement. If you look at how retirees actually spend money, the year after they retire, they spend almost exactly the same as they did the year before they retired, but then the spending tends to go down. It tends to follow something that looks like a spending smile. So spending goes down every year into your 70s, and then it goes up a little bit as healthcare costs increase. And so what we do is we match that spending path to the consumption path in retirement. So we're not smoothing spending. We're smoothing it the first year, but then spending is going to decline every year after that. Or we're going to assume 50 basis points in fees, and we're actually going to calculate, given Social Security, given taxes, how much people would really have to save in order to match their lifestyle after retirement. We're also going to assume differences in longevity by income level. So we're going to take that slide that I showed earlier, that there's differences in longevity by income level. We're going to incorporate that into the analysis. So that means that those who have a higher income are going to live a longer time on average, which means that they need to fund more years of spending in retirement. We're also going to assume their income growth rates in those higher income groups are higher. All right, so what does it look like when we actually optimize? What we find is, and I put it in red just so you can focus on the $50,000 income of an average American. If you use historical returns, let's start at age 25. If you use historical returns, the optimal savings rate is about 8%, not that high. In a low-rate environment, and in fact, I think this low-rate assumption, which is 3.5% real on equities, and today's yields that are slowly going up over time, I think that's actually somewhat optimistic. So with that somewhat optimistic scenario, you're going to have to save about 14% of your income to be able to smooth spending the first year after retirement, and then of course spending goes down every year after that. For a joint household, each of which they're at the same income level, but they're getting 2 Social Securities, especially at those lower income levels, it's not as dire. But once you start getting to the higher income levels, people are going to have to save a lot more. And that difference between the joint and the single converge because Social Security makes up such a smaller portion of their post-retirement income. If you start saving at age 30, those savings rates go up significantly. If you start saving at age 40, and what's really interesting here is look at some of those. If you start start saving at age 40, and you're in one of those higher income groups, you're going to have to save a quarter of your income to be able to smooth spending in retirement. That's a big chunk of your income. And even then, that's relatively optimistic return assumptions. That's assuming that you're only matching your spending the first year after retirement, and spending is going down each year after that. So that's the depressing stuff. Now, what are some of the potential solutions? Well, the easiest potential solution is simply to retire later. If there's increases in longevity, of course, retirement is going to get more expensive unless you retire later. So what we see is that that difference can be relatively dramatic between retiring at age 65 and retiring at age 70, especially in those very low income groups. If you wait till you're 70, you're going to get such a generous Social Security income that will still match a big portion of your pre-retirement income. So it's not as dire for those moderate to lower income Americans, just as long as they're able to defer Social Security, and Social Security continues to be as generous as it is right now. So this is what it looks like. Do you think workers will actually do this? So I asked a question, I slipped one of these questions into a survey recently, if you had a choice of a 14% savings rate with a 100% degree of certainty or a 9% savings rate and have a 70% degree of certainty of making your retirement spending goal, what would people choose? What would you think in this room? Who would choose 14%? But you would think most people wouldn't, right? You would think the average American wouldn't. This is the results. And it's more dramatic for lower education workers. They would be more willing to save more. And that was shocking to me, but it's actually, the more of these, I do surveys for insurance companies, occasionally slip these things in just because I think it's fun. And what I see is consistently, people are willing to save more, and actually that shows up if you look at Autoescalation, the percentage of employees who stick with Autoescalation, it's like 90% will stick with Autoescalation, and that Autoescalation will rise up to one of those higher savings rates that are going to be required. I'm out of time. This is how people are actually saving for retirement. This is an important point to make, that if we auto-enroll, if we auto-enroll at 3%, the average savings rate is lower than if there is no default savings rate. If we auto-enroll at 6%, the savings rate is almost identical to having no auto-enrollment. The only answer to getting people closer to the right savings rate is auto-escalation. That's the only way it's ever going to happen. And the last point I want to make is, and I know I'm over time, but this is an important point to make, the only way we're ever going to get to better lifestyles in retirement is by using mortality credits. Mortality credits become more important in a low interest rate environment because they become a bigger portion of a retiree's return that they get from the retirement savings. So one point to keep in mind is that we've got to think of ways of automatically annuitizing retirement savings. Thank you.